Hey, what's going on, Aerial Effects team? Hope you all are doing well. Welcome back to another Aerial Effects video. In this video, I will be discussing supply and demand order blocks and how to properly trade them in your everyday trading life. Now, I know I said order blocks. That is just what everyone knows about. I call them order regions or simply supply and demand. They're the same thing. They're traded the same way. So for the sake of everyone who is probably familiar with the term order blocks, I'm going to be using that term today, just so you don't get confused when I do say something like supply region or demand region or LPOR or anything like that. They're the same term, the same way of trading it, so I'm going to be using order blocks. So what is an order block? Now, we first have to understand the basics of smart money liquidity runs. All right, so when liquidity is introduced into the market, usually it kind of looks like this. It's not always this pretty, but essentially what liquidity is are orders. That's why they're called order blocks. Now, before I get into what a block is, let's go over what orders are. So orders, in essence, are, in this case, buying orders from a particular area of support. All right, this area of support houses a lot of buys, so you would expect a lot of stop losses to go below this low because many people, when they're trading buys here, they're placing their stops below the low. Retail is buying at support. That's what they're told to do. So the banks know this. So let me go over this really fast. How many times have you said in your trading career or trading life that, you get stopped out by a few pips and then price goes in your overall direction? I'm sure you've probably said that at some point in your life. I know I have when I first started, but that is the whole point of smart money. They are looking to attack your stop loss. Maybe not yours in particularly, but in a group of people trading the exact same level. So when thousands and thousands of people are trading this exact same level here and they're looking to buy off of the support and put stop losses below, there's so much liquidity or volume or orders resting below this low here. So the banks understand this, and what they do is they pump price down to take the liquidity. They hit your stop loss. They grab that liquidity that you had resting below it, and then price oftentimes shoots back up in the correct direction of trend. Now, we understand that the banks move the markets, not us. The central banks are the ones manipulating price. We don't move the markets. We are too small a fish in order to do so because we know Forex is a multi-trillion dollar a day industry, so we are not the ones moving price. The big banks with the billions and billions of dollars are the ones doing so. So when they see and notice that there is a lot of liquidity resting below this particular low here, for instance, they have to sell the market in order to take that liquidity. So let's just say, for instance, I'm going to make this up. Let's say there's $100 million of stop losses resting below this low, and it may cost them $50 million to pump price all the way down to take it. Well, they're going to profit $50 million. 100 million minus 50 million is $50 million. Now, after they've taken that money, they have to reverse price, or they oftentimes reverse price in the opposite direction, right, or in the correct direction in which the price is already meant to go to continue with the overall trend in the market. But the problem with this is that they're still short here. When price is all the way up here, they're still short starting from where the liquidity was run, in this case, when they started to sell. So they're in drawdown on their shorts. They have to get out of their drawdown. So when the term mitigation comes to play, that means to make less severe. That's what the definition is. And to make less severe in this market is to essentially break even. So the institutions and banks have to break even on their short positions before continuing with the overall longs. So that's why price comes down and mitigates the open of where they started to short from before continuing. So now they are out or break even from their shorts. They've made money shorting the market by taking the stop losses. Now they can continue with their overall buys in the market and continue to repeat the process over and over again. So the market is run off of liquidity and volume. It is not run off of these patterns or trend lines or Fibonacci's or any other BS that you may have been used to trading. I was victim to retail trading when I first started, but I learned very quickly that that's not the reason the market does what it does. So after this occurs, it creates an order block, right? There are orders trapped within this region of price, right? Between here and here, short orders by the institutions. So it creates an order block. Oftentimes, this order block mitigates a potential other order block right in here, which is why price has continued to push higher, has pulled back, generated liquidity, has that overall pullback in the market, taking liquidity, mitigating another order block that was already present potentially, and then creating another order block in the process, right? Now we come back down and mitigate that same level before continuing to the upside. Now I'm going to give you a few examples here of how me and my VIP community, our program holders, have taken advantage of many, many trades very similar to what I have just shown you. All right, so I'm going to go back to the charts here and we're going to break down everything that's been going on in here. And I think we had about 4 trades that were taken. And I'm going to show you proof of the exact markups that were sent prior to these levels being met within our VIP community. All right, so let's take a look at what's going on in here. So we can see that well, first we have to understand market structure. Higher high, higher low, higher high, we already are assuming a higher low. Now, what is going on in here? Well, in here, we have probably come into, well, this actually is relatively equal low, so that will be taken out when we shift structure to the downside. But after that occurs, we create an order block right in here. Okay, this order block comes into play, and we can see we mitigated that very nicely. This is an order block right in here. We had the sell price, taking liquidity, moving in the correct direction. Pull back, mitigating this order block, continuing. Push back down, and we can see on a lower time frame, this wick has taken these wicks in here. These are lower time frame lows that price has taken before continuing, in the process mitigating an order block. Now the new order block comes in, and we create this. So we can see here that yes, we did mitigate this kind of. Really, the order block is sort of right in here, right, with this last selling volume, right? But we can see the expansion that occurred after this last selling volume took place, creating inefficiency. So this is where we have to tie in other components of smart money in order to understand the holistic strategy that smart money has to offer. So between this wick and this wick here is just straight buying volume. There's no sells that were allowed in here. All right, so now to make the market efficient, we have to come back down and fill the imbalance. And we can see here that we didn't do that here, or here, or here. And now we can see we're generating liquidity. We're creating these double bottoms, triple bottoms, quadruple bottoms, stuff like that that retail traders are buying from, which creates the order block. Okay, so now when we come in here and sell down into the order block, we mitigate these sells before they continued with their buys, sweeping liquidity in the process. And now they're consolidating and eventually continue to the upside. So we know that in that process creates another order block. We can see in here with this wick, we sweep these relatively equal lows on a lower time frame. On the lower time frame, we are generating liquidity. We sweep that liquidity, and then we continue creating the order block in here. All right, so now I'm going to get rid of all of the drawings here, and we're going to continue with this analysis. Now, what I'm going to do is I'm going to use bar replay here, and we're going to go through kind of step by step how we can break down charts. This is all hindsight, but in all reality, we have taken all of these trades that I'm about to go over. I will show you proof here in a minute. I just want to let you know that this is not all hindsight, because many people will go back, find trades that look good, and make videos and create fake setups that have to do with hindsight-based analysis. At Aerial Effects, we're not about that. We want to show as much transparency as possible. Of course, we lose trades. Everyone loses trades. In this case, we didn't lose a trade in here. We got very, I wouldn't say very lucky, but we understand price movement, and we happen to continue in the correct direction of trend, mitigating each and every one of these order blocks pretty much to perfection. So it did work out very well for us. And I'm going to show you all of these examples. So let's first start off in here. So when price is pushing to the upside, right, we swept the liquidity and then we continue to the upside, creating that higher high. All right, so now we know that we have our order block right in here. Okay, so this is where the liquidity was run. all these equal lows, and this was our last selling volume before the big expansion to the upside. All right, so let's see if price can come into this region. So it did. We tapped up into this region, and we can see on the 1 hour time frame that we are starting to generate liquidity. Now there was no clear counter trend to play off of, right? Oftentimes we'll see a counter trend like this, that we can play off of upon a break of counter trend structure to ensure that when a pullback occurs, we shouldn't be going below this low. But in this case, there was nothing to play off of. We just kind of had to wait for more price action to come around before entering our long positions. All right. So we can see that we're generating liquidity, these relatively equal lows here. All right, so I'm going to continue to play out price, and we have another reaction. If I extend this trend line, more people are buying at this level. One touch, double bottom, triple bottom, quadruple bottom. Retail is buying, placing their stop loss below each and every one of these lows. So there's liquidity resting. So I'm sure the banks are like, okay, well, in order to mitigate this order block here, I have to generate liquidity to come and take it, free up enough liquidity for me to place my large contracts or large volume size to then continue with the overall direction. All right, so this was our 1 hour time frame liquidity run, and we can see that we sold off and we broke this counter trend structure. We can see the counter trend in here. It's very discrete, but it's easily seen on the lower time frame. We finally broke that. We continued to pull back, and now we went long after breaking the structure. So we had, actually, I don't think that we bought price here. I think that after seeing this analysis, we then formed another order block, and then we played off of it. And I will show you that in a minute. So this was June 26th. So now we're going to continue to see what price is doing. We chop around a little bit, and then we break the counter trend structure in here. So now this becomes our overall higher time frame order block. Okay, we can see that the liquidity was run, sell to buy. We have broken the counter trend structure, which is why when we push down into here, we did not break and make a lower low. That is why we stopped, made a higher low, and then made a higher high. So this becomes our new order block, and now we're looking to take price down into here. Well, we're not going to be looking to sell. We're going to be looking to buy from this level. That's exactly what we had right in here. So this was a chart sent to our VIP community. We can see it was published on June 28th, right? Higher high, higher low, higher high, higher low. We had the 4 hour order block that we came into, ran the liquidity on a lower time frame, and broke the counter trend structure. And now that's exactly where we're looking to come into before continuing to the upside. All right. So let's play this out a little bit, see what we can get. I'm going to extend this if we need to. All right, so now we are pushing down into this. And I know it seems as if, we may hit our stop loss, but we have to be patient and just wait for it to play out. If it hits our stop, oh well. If it doesn't, then great, we're going to be making some profit. So price actually did come all the way back down, and we almost hit our stop, but we maintained structure and we continued to push to the upside as expected. Now, before I go any further, I want you guys to understand the higher time frame. Now, the reason why we're buying in all of these demand or order block regions is not just because they're order blocks or because structure is to the upside. That's all great confluence in which you need, but we have to understand the higher time frame here. Look at where we're pushing into. You see the high that was generated. Look at where that rests, right below 2018 high. We can see that we pushed up and then pushed all the way back down and created that low. So we're approaching the high here. How much liquidity do you think is resting above this high? Probably a lot. So if I pull my horizontal ray, I will just put that right here, and that will be at 1175, which was our overall target for longs. So we can see all the way over to the right here, we never came up into it. So that is the reason why we're continuing to look for longs at these order block regions of demand after these big pullbacks, because we failed to come up into this liquidity. So we still technically have room to go to the upside. Now, if we already came into this level, we wouldn't be looking for overall pushes to the upside still, because the objective has been met. The whole premise of my strategy in particular is to understand market structure, understand the higher time frame objectives. Where is price looking to push into? Where is the overall objective the market makers are looking to take price? Now it's all about scaling into the lower time frames, finding these order blocks, finding these supply and demand regions, and then based upon the smart money concepts that I know and that I teach, we can take trades with really, really good confluence and very high conviction. Now we can see that this is relatively equal highs. I know that we swept liquidity here based upon this high, but still liquidity is resting above that high. We need to go and grab it. So we continued. We pull our handy dandy risk to reward tool. Now I know this isn't the best risk to reward in the world, but it will do for now. This happened to be a 50 pips stop loss, and all the way up here, it did meet my rule of a 1 to 3 at least. It is a 1 to 3.46. We'll call it 1 to 3.45, just to round it off to make it 5 and then round figure zeros. So 3.45, I'll write that down so we can save that for later. And this is the actual trade that was taken within our VIP community. As we can see here, that was the pre-analysis to it. And we can see that we are looking to push to the upside, creating that higher high, taking that liquidity coming into that 1.1175 level. So now I would like to scale into what's going on in here, because why did price push down so far? There must have been something down into this region of price that made price push down, because there's always a reason behind every single movement in the market. So let's scale in to like the 15-minute time frame and see what's going on. What I'm going to be doing is I'm going to put a horizontal line at the very low right here, because we stopped at that point. So let's look at over to the left why we stopped right there. Well, we stopped right there because we must have come into a specific level, and then we actually did. So what can we notice about what's going on in here? For one, we accumulated in price. This is how we can add Wyckoff to the scenario. So we trade smart money, supply and demand, and Wyckoff. They're not individual strategies. It is a compilation that you can use for an aggregate strategy to put everything together as complements, right? Into one particular bulletproof smart money strategy is what I like to call it. So we can see here, this wick, where did this wick come into? Well, this wick came into a lower time frame order block. We can see here that we swept liquidity, these relatively equal lows. I know it's the 15-minute, but I bet if you go on the 1-minute time frame, these are very much equal lows, or a lot of liquidity resting below here, lower time frame. So we know we have scalpers, we know we have intraday traders, we know we have position size traders. The markets are fractal. Every single concept can be applied to every single time frame. I like to give this analogy when I say this. The analogy is, and you probably have seen it before, you know how if you've seen one of those videos where there's a particular object and that object is being zoomed in on, and as you zoom into that object, it goes into that object and it looks the exact same as it's going into it. It's almost like 4, 5, 6 dimensions or whatever, but you keep scaling in or keep zooming into that same object, and it becomes smaller as you get into it, and then becomes larger, because within that larger object is that same object, and you scale into that object and you keep repeating the process, you keep zooming in, and it keeps looking like the same picture. Well, that's the same thing with Forex, guys. It's fractal. That's what we mean by fractility. The markets do the same thing on every single time frame. So the same thing applies. Market structure, accumulation, liquidity runs, imbalances, sponsor candles, breaks of counter trend structure all occur on the lower time frames as they do on the higher time frames. Liquidity runs, accumulation, higher time frame. We have the break of counter trend structure here. We had that same thing on the higher time frame within that 1 hour, 4 hour level, sweeping liquidity, breaking that counter trend to the upside, forming that order block. We had a little bit of an accumulation on the lower time frame there, but we can see that everything occurs on every time frame. So going back down to that 15-minute level, take a look at it. So this sell to buy, we came in and mitigated that region. The banks sold price to then buy it. Now they need to break even on their sells, and now they push price to the upside. That's why we failed to make a lower low here as we pulled back, and that's why we made that higher high and continued with the overall trend. Now, what is going on within this black horizontal line? Because that's where price came into originally. Well, we can see more liquidity being built up right here. And I'm going to use a black line because that blue on blue is kind of weird. Anyways, relatively equal lows. So we're going to put our handy dandy X right there to signify liquidity. We come down, run that liquidity into this wick here, because what is a wick? In this case, a wick to the downside is selling and buying at the exact same time for price to close at that level. So we know within this wick is a sell to buy candle on the lower time frames. So that's exactly where we came into all the way over to the left, or excuse me, the right. We mitigated that level. We actually formed more liquidity in the process, sweeping it, pushing up, failing to make that lower low, and we make a higher high, breaking that counter trend structure, creating yet another order block to play off of right there. So when we pulled back, we could have entered, sell to buy, and then we just continued and continued and continued. All right, so we're starting to see how we can put the lower time frames in conjunction with the higher time frames in order to trade in the correct direction of the higher time frames, but also on the lower time frames, being able to use the same concepts to have more precise entry. So that could have been an entry for you. It would have been quite tough because the spread may have been too high for you to have been filled in that position. But this, having seen and understood the higher time frames, you know that this is the overall order block in the market. We had that sell to buy that came in to this 15-minute order block here. We created equal lows. We had the reaction off that level, off the sponsored candle within that wick that swept liquidity. And then we swept more liquidity in the process. We failed to make that lower low here, and we made that higher high. So this demand or order block region, you could have entered right in here. We did not do this. I didn't see it in time because it is 2:33 in the morning. I am sleeping at that time. That's London session open. But still, time and price, London session open, for all you London traders out there, that would have been a perfect opportunity for you. Now we can see here, this is a lower time frame trade. Let's call it 15 pips just to make it even. We can see below the low, and now we can target our higher time frame level because now we have come into a higher time frame level. We have confirmed on the lower time frame. So now we don't necessarily need lower time frame targets. We can have a higher time frame target because this is a overall higher time frame play. So let's bring this all the way up into that 1175 level, make it pretty, and scale back in to see what that risk to reward would have been. You would have had a 1 to 13.27 risk to reward if you had taken that trade. That trade in and of itself could have passed a funding prop firm challenge for you. But even if you didn't use that trade, that is okay. We are still taking advantage of the higher time frame setups. If you do not understand how to confirm trades, or maybe you're not up at that time, or maybe you just missed it, that's okay. This is still a 1 to 3.45 risk to reward. That's almost close to halfway there for some prop firms, right? So let's continue. Let's go back to the higher time frame and let's continue here. All right, so that was our order block that we mitigated. It is currently July 4th. So now we are continuing to push higher. So now in here, what is going on? Well, in this process, the higher time frame, so the lower time frame we talked about, but the lower time frame created the higher time frame order block right in here. And oftentimes we will come down and mitigate the order block, but also an order block within an order block. We can see that this last sell to buy creates that other order block for us to come and mitigate later on. I'm going to make this orange just for the sake of it. Okay, and we also have a miniature level of demand here, a mini order block. I wouldn't really classify that as an order block, more along the lines of a repricing event, because technically we sold, we bought, we repriced and continued. Repricing is to kind of make the market efficient. It's just the bank algorithm's way of kind of filling in balance a little bit. But we can also see in here that we have imbalance between this wick and this wick. So this is a very imbalanced move. Price will oftentimes come deeper into our second order block or a higher time frame one and here to fill that imbalance because there's only buying volume that has been allowed. We need to make the market efficient, and it does that in the correct direction of trend. If we're bullish, it will often come down and fill sell side imbalance or fair value gap, whatever you want to call it. I know, many people have different terms. I just call it imbalance. And then we will continue with the upside momentum. All right, so let's see what's going on here. We just missed that level, and we can see that we are accumulating on a lower time frame in price. We had just missed that level, and that's okay. All right, so we had accumulation, we had our fake higher high, well, our overall higher high, because technically this is the low that produced this high that actually took out this high. What we can see here, this is more of a liquidity run. Equal highs. Many people are selling off of these equal highs, right? Because it's resistance. That's what they're taught to do. So when price comes back up, sweeps that liquidity, 9 in the morning on July 8th, that's exactly, New York session open, for me at least, we push back to the downside. Now we still have these interested levels, okay? So we're going to keep these levels open. I'm just going to extend them just to see where we come in. And we can see that we came into our first region of price and we had our push to the upside. Now, I had my risk to reward like this. I'm more of a conservative trader. I like to trade within the lower time frames but have higher time frame stop losses on occasion just so I can ensure that I'm being safe. So in this case, this is a 1 to 4, we'll call it 1 to 4 risk to reward, but I had 2 positions, one right here and one right here at the open of this, right? So I'm going to clone this and put the second one right here. And because I've had 2, I only risk 0.5% on each because I'm treating this as one setup. All right, so we have a 1 to 4, which is really a 1 to 2 because we're risking 0.5%. And then the other one is a 1 to 7.54, which is essentially a 1 to 3.75, if I'm not mistaken, if my math is correct. So in total, that is 5.75% if both of these hit and hit take profit. All right, so now let's see what price is doing. Well, before I get into that, let's see what happened. We created liquidity. We ran the liquidity coming into the order block. Mitigating orders, now we can continue with the right direction of trend. We push back to the upside. We create another order block in doing so, right in here. This creates the other order block. We come and mitigate it and then continue. We create another order block right in here, and then we come back and we'll probably hit that as well. Now, I will show you where we sent that out. I think this was the second one. Yep, this is the second one. Remember the 2 that I just showed you right here? These 2, boom, boom, 1 and 2. That's where we sent our analysis out. And we can see the lower time frame. I was doing some lower time frame analysis, and here we had accumulation. Remember we talked about that? And this was sent out on July 5th. So there's the proof there. AUD NZD. Now what I'll also show you on the lower time frame, if we head down to the 5-minute, so we had the reaction from the level, we actually accumulated. We created more liquidity, right? We sold price, bought it back up, okay? We sold price, sell to buy, sweep all this liquidity. What does that create? It creates our order block right there. Boom. We mitigate that order block, and in the process, we sweep all these lows on a lower time frame. This is relatively equal lows. We have relatively equal lows here. We sweep it with this move, sell to buy. We create that higher high. We broke structure back to the upside, right? So now we create another order block in the process right in here, right? This was our last selling volume before the up move, and we came into this level perfectly. We also, when we push back up, had a little bit of a pullback, and then the higher high created another order block. Boom, right in there. In that process, we created another order block, which is right in here, all the way over, and we mitigated that. Higher high was formed. We generate some liquidity in here. Boom, sell to buy. I'm sure there is something that's probably more pretty than this. This doesn't look that pretty, but again, we sold price to take all this liquidity here before the expansion to the upside to continue with trend. So there's probably some sort of order block within this region of price in here to entice, well, not entice, but to mitigate from, the banks had to sweep these lows, take the liquidity, mitigate what's here, because usually this is the order block, or this was the order block that came into this order block, that came into this one, that came into this one, that came into this one, that came into our overall one over to the left. All right, so it's just a mitigation train, if you will. Okay, Now we have generated tons of imbalance. We had this strong move. There's just buying in here. There's no selling that was offered. So to make the market efficient, this becomes our new order block right in here, right? This entire level and the imbalance fill, okay? Because the imbalance fill would be this wick, because this wick had selling volume. And then we had the buying volume above that wick, but we didn't have any selling volume between these wicks and this wick. So now we have to come back and fill that. So let's see if we can move price back down to come fill and hit that order block. We just extend this over. Oh, we just missed it. Oh, and look what happened. We generate more liquidity. Look how perfect this is, guys. I can't make this up. This happens every single day. These equal lows, generating more liquidity, enticing more retail traders, to come take a position, to come take a buy position prematurely. But really, in all reality, this is the correct region because this is what took liquidity. So we need to mitigate these orders in here. The banks are selling to sweep liquidity and mitigate something else. They had to do the same thing here. Sell price, they had to come down and mitigate this level, probably down in here somewhere. That's why we pushed down into it. Generating liquidity. We generated all this liquidity prior to sweeping it, sell to buy, move. That's exactly what happened. So now let's see if we get the reaction, and I know we did because we did take this trade, and we had our push to the upside. Just extend this over. There we go. We continue. There we go. Now we have our move. So I know that we came down almost close to stop loss, but that's why we have to place our stop loss right below the low to ensure that we don't get hit out. And that's exactly what happened. We did not get hit out there. So if I just type 1175 to this, because that is our overall target. That has been our overall target ever since we started trading AUD NZD longs, right? So now we push back to the upside. This is a 1 to 11.52. All right. So in this case, we take partials throughout. I took partials while we were in profit here once we broke this structure, once we get up to it. We haven't done it yet because we will come down and hit our second level, but I do take partials when we create a higher high. So in this case, since it's a lower time frame trade, and you guys could have taken trades all in here if you needed to. I mean, there could have been 1, 2, 3, 4, 5, 6 trades just within this region of price, not to mention these two that we had in the prior one right here to the left. So many opportunities, but you have to be able to understand the concepts and apply them the right way, right? So this is why I'm here to teach you guys this. So we created that higher high. Okay, so that was sort of a liquidity run. Let's see if we continue a little bit. And I think we started to push down now. So look, so the partials were taken, stops moved to break even, and we did get hit out break even, but I'll show you the position in which I was talking about. This is right here, the liquidity that was run and the accumulation that occurred, the Wyckoff that occurred within that higher time frame demand level, as just discussed here. This was our higher time frame demand level on the 1 hour. Right here, we accumulated lower time frame within that level, creates that Wyckoff schematic for us to ensure that we are now looking for buy positions in this direction, in which you could have about 6 or 7 times, right? So that was the trade, that inefficiency, that order block here, boom, boom, and we got a great entry. Okay, so again, the reason why I'm showing you this is not to brag, it's to tell you guys that I'm not just looking back at past price and trying to find setups. This was real time, real stuff that I was sending to my members. And you can see that was July 13th. That was prior to price coming into this level. This was July 13th right here. So obviously I couldn't have made that up. And I also created another video on YouTube if you want to go check that out at a later stage. I think it's titled like Trade Recap or something like that. It's one of our more recent videos. Highly recommend you check that out. I go over all of the trades that were sent to our VIP community within the past 2 weeks. I only wanted to do the past 2 weeks because there was just so much to go over and would have taken me hours to go even further. And I show proof just like I show proof here. So it's not just hindsight BS. It's real-time stuff that I'm actually sending to my group and my clients prior to getting in these trades. But nonetheless, let's continue here. So let's go back to the higher time frame. And let's continue with price. All right, so now we have that entry, boom, right there. Beautiful. So the entry was actually up top here, wasn't within this 1 hour tiny order block within the overall order block. So that's why I had my entry here. But nonetheless, we pushed down into that same level and we reversed back to the upside. We created more liquidity in the process. And we also had another opportunity right here. And this is where I wanted to buy it again. So we had the reaction. And then within this 1 hour time frame, we created another order block or another demand. We sold, we bought, we repriced, and we continued. So that is where I wanted to pull back into to buy it. Stops were below that low, right? So the reason why they were below that low is not just because it's structure, that's where we reacted, but it's also because if we move to the 3 hour time frame, we can see that we could have gone down a little bit further into this level of imbalance between this 1, 2, 3 pin pattern. This 3 hour order block was mitigated. I'm just going to make price look the same because I know it's a little skewed. Let's just go 20 there. There we go. Perfectly mitigated, creating another order block in the process. This 1, 2, 3 pin pattern. Look how similar that is. 1, 2, 3, enter into a level. 1, 2, 3, enter into a level. Expansion. Imbalance. We will eventually come back down and tap that, and that actually happened on the 1st, or actually the 2nd of August, if I'm not mistaken. All right, which was 2 days ago. But this was July 17th. So in 2 weeks from July 17th, where we took this trade, we will then come down and mitigate this level and to go long. So we'll just continue. So there we go. Let me go back to the hourly time frame, and that's exactly where we came into. Hey, had a little bit of drawdown, but nonetheless, that order block was taken care of. Stops were below this low. We filled that imbalance in the 3 hour. That's why we had that sell to buy. And even if we scale into, like, let's just say the 10-minute, we create and generate so much liquidity. Look at all this liquidity that we're generating. These equal lows, 1 touch, 2 touch, 3 touch. Retail is buying off the double bottom, the triple bottom, maybe the quadruple bottom. They're trying to buy it. Nope, we sell it, or the institutions sell it into our region of price, right? And then we react and go long. So it's a massive sell to buy, creating a higher time frame order block right in here. But we can see that with the 3 hour order block right here, as just discussed. So this is why we have to do top-down analysis. There's no such thing as just taking trades off of the 1 hour or just taking trades off the 15-minute. You need a holistic understanding. Remember, I just went to the 3 hour time frame. I went all the way down to the 5-minute or 15-minute time frame down into here. We went to the hourly time frame. There's 5-minute time frame within here, these order blocks that we could take advantage of. It's having that holistic understanding, putting everything together to form this amazing strategy that plays out time and time again, because this is exactly how the market is supposed to move. It is how it moves because it's based upon liquidity and volume and order taking. Who is making the money in this market? It's not us. Well, we can take advantage of it and make money, but who's making the millions and billions of dollars? It's the institutions. How do they do that? They have to spot liquidity in the market to then go and take and then move price in the opposite direction or the correct direction, right? Sell to buy. And then they have to come down and mitigate that level to get out of their original positions, or else they be continued, or they be in drawdown on those positions. So that's why price comes down and mitigates these order blocks. We'll just call them order blocks because that's what everyone's familiar with. So as we continue, this is July 18th. All right, perfect. We will continue here, higher time frame, and price will just continue to push all the way up. And look at that. We swept these highs and we came back up to sweep 2018 highs, and we swept that liquidity very nicely, hitting all of our take profits. So in this case, let me just put this one up because I forgot to draw that up. That was our risk reward. Stops were below the low. And I think it was like 38, let's call it 38 pips. Price pushes all the way back up here, 1.1175. That is a 1 to 4.3, right? So if I calculate it, 4.3 plus 4.3 right here, I'm going to count this one first. Half of this one and half of this one, because remember we took these on half risk because they were one position technically. I treated it as one position even though it's two, but that was what, a full 1 to 4, 1 to 7.5. So half of each of those is 2 and 3.75, and then this one was the full risk 3.45. So 3.45 plus 2 plus 3.75 plus 4.3 4.3, that equals 13.5%. And in here, we didn't hit our overall target because we came down, hit break even. I think I took like 33% off the table, but I'm not even going to count that. Let's just say 13.5% for these 4 positions here. So if you took just those 4 positions over a span of, let's say, from when we first entered our first one all the way up until when it hit, 26 days, let's call it 27 days. That's close to 28 days, which is 4 weeks. So in a month's time, you would have made on one pair 13.5%. That easily could have passed a 4x prop firm challenge for you. So that is what I have on AUD NZD. I'm going to go over one more pair. So stick around. It's going to be a brilliant analysis, and it's really going to dive deep into these similar concepts. So hopefully as you start to see this over and over, obviously I say this all the time, repetition creates habit. Okay. So if you see this time and time again, it starts to become second nature, like ingrained in your brain. And this is really where we want you guys to be. So actually, excuse me, before I finish that, I'm just going to get out of bar replay, and we can see we reacted and had that overall push back to the downside. And look where we came into that 3-hour doji candle that I talked about. Boom, right back to the upside. So now, what do we have here that's generating? We have this trend line liquidity. How many times have we moved away from this trend line liquidity? 1, 2, 3, 4, 5, 6 times. 6 times retail has had the opportunity to sell. So many times are they selling off these double tops, triple tops. They're not triple tops because they're not tops, they're just trend line liquidity. But we know that retail loses. This is where the liquidity lies. So we need to go and take that liquidity. But what else are we doing? We're forming more liquidity. These equal lows. 1 touch, 2 touch, 3 touch, 4. What is below these equal lows? It's just brilliant, guys. Brilliant, brilliant, brilliant. 30-minute. We came into that 3-hour level. We pushed up, we repriced, created that order block, and then we expanded again. So this is the order block, and this is exactly where I want price to come into. This is a current setup, and this is, I guess, there you go. Here's your signal for all you who want signals. There you go. There's your signal. This is what we want to see: a sell to buy, continue with the trend, take higher time frame liquidity, sweep lower time frame liquidity, mitigate the order block. Potentially, sell to buy, pull back into another order block to then buy it again. Guys, it's just repetitive process. But you need to find these or understand the concepts, but also be patient enough to wait for price to set up like this. Remember, these 4 trades that we took a month to set up and hit take profit. So you have to just be patient with it, understand the concepts, and once you do and you're patient enough and have good psychology, this stuff is just boom, boom, boom. You're pumping out profits every single solitary day. This is just one pair. We have 26 pairs to deal with, right? But I'm only going to go over 2. Next, AUD Swiss Franc. So let's break this down top down. All right, so let's start off with the daily time frame. We are what? Bearish. Boom, we're bearish. We're pulling back, but we're still bearish. Where did we come into? We came into a mini level of supply, daily time frame level of supply. Boom. Okay, so that actually happens to line up with that 1-hour consolidation block before we continued. We pushed up. We failed to push up into that block that generates the liquidity. Liquidity here. We did push up into the block, right? But we had one more run up into the high. All right, so this is where I want to get into. Okay, so actually, excuse me. Sorry about that. I'm going to use bar replay, and I'm going to start off by talking about what's going on here. So as we approach our level, and I think if I just make this a little bit better, let me just push this up because this is where our last buying volume was right here. That resulted in the push to the downside. So technically, we haven't really pushed up into it yet. So now let's see what's going on. So let me go down to the 15-minute time frame. All right, and now, as we can see, we are starting to distribute in price. We're starting to distribute. We have swept all of this liquidity. Boom, boom, all of it. We've swept it. We've come into our higher time frame objective, and now we're looking to potentially push away from it. discrete higher highs, higher lows, potential distribution forming. Let's continue. Boom. Okay, so now that we have broken the counter trend, we have distributed. Boom, 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 push down, reaction off of this order block, but we failed to make a higher high. This is expected because we already came into our higher time frame level right here. I know we did here, but we never reacted and broke structure. We continued and made a higher high. So we see the reaction from it. We wait for the distribution to be over and the break of structure to be finished. And we did. We closed below the structure point. So now we are overall bearish again. Okay, so now what's interesting is that as we create or fail to react off of this order block and push down, it technically creates another order block. Where is that order block? Right here, this supply zone. The demand is now invalidated because we never made a higher high in this higher high, higher low sequence, and we made a lower low, so this flips to supply. And I made a whole other video on YouTube about supply and demand flips, so if you want to go check that out, it's very interesting. It works pretty much everywhere and anywhere you go. Very cool and valuable skill. So our entry is right in here. We want to pull back up and mitigate this order block here. Okay, so we didn't do that right away, and that's okay because we're generating liquidity. Oftentimes we generate liquidity in order for price to push up into it. Because why do we have to do that? Well, we could immediately just come up and mitigate, but oftentimes we will maybe come back up and mitigate a second time before pushing to the downside. And I'm going to show you an example as I go through this. The reason why this occurs is because not all the time can can the institutions fill the rest of their contracts or get out of all of their positions all at one time. So they have to come up and do it again. Because if they have hundreds of thousands or potentially millions of lot sizes or standard lots, they can't take all of their positions out at one time. There's not enough liquidity in order to do that. So that's why they have to generate liquidity. They generate liquidity so they can free the liquidity up by taking people's stop losses. So now there's orders available to place at that level, if that makes sense. Okay, so we're going to continue to play this here. We push to the downside. So this was a lower low, a false lower high, and then a lower low. This is a false lower high because technically this is still the supply in the order block in which we need to come up to. And we can see that we have created descending liquidity. 1 touch, 2 touch, 3 touches. So oftentimes what will happen is we get these reactions from the trend line to entice retail shorts in here. But then we push right back to the upside. This is not a break of structure when we come back up in here. The reason why it's not is because we're overall bearish now, and we confirm that over to the right. We have distributed in a higher time frame level and broken structure, so we're bearish. So technically, this is our trend now. So that's what we need to be following. If we were bullish and did something like this, and then we broke, then yeah, that would be breaking counter trend to pull back and go long, but we're not bullish, we're bearish. So any pullback is not a break of structure, it's just an overall pullback higher time frame, because this is a lower low, lower high, lower low, lower high sequence on the lower time frame, but the higher time frame, it's the same thing. Lower low, lower high, lower low sequence. See? Fractility. That's how it works. We continue here, we push all the way back up into that level, and then we come up a little bit higher, but we had our, I'll just put it right here, we had our stops above this high because this was the last buying volume before the major sell-off. So the stops need to go above the high. Let's call it 23 pips to make it even. And we took this all the way down to our 1 hour order region or order block at 6, if I'm not mistaken, 6.5? Yeah, I believe it's 6.5. There we go. And I'm going to show you right there, 6.5. Or excuse me, no, we didn't. Where was this? Oh, we took it right here, 662. Okay, the 6.5 one, I'm thinking of another setup that I'll show you in a minute. We just haven't gotten to it yet. Sorry, 662. Okay, reason is because technically we're still counter trend bullish, so I really wanted to just run this liquidity here, run these lows, because we can see here liquidity is forming, and we have this order block that has not been mitigated yet in this sequence, right? So that's why I just had my take profit here at 6,620. Okay, and we can see that with this right here. Oops, there we go. So this was our entry. That was exactly what we're looking for. Distribution up into our level, created the order block into our supply. We broke, and then we wanted to pull back and short it off. So that's the analysis behind it. We can see that was provided on July 26th right there. And that was way before we came back up, because that was July 27th that we actually entered. All right, so let me go down to the 15-minute time frame again, and we can see that we're creating more liquidity, sell side liquidity to run. Equal lows, double bottom, people are buying. This is the drawn liquidity. When I say drawn liquidity, that means when we sell it in here, the draw would be to go and attack that liquidity next. Gives us more conviction for our shorts. All right, so we actually pushed up a little bit higher into this 15-minute tiny order block region. This was our last buying volume before the sell-off. I wouldn't classify that as a sponsored candle, but more or less a lower time frame 15-minute area of demand. It's also imbalance, as we can see. Between this wick and this wick, we have imbalance in here, just straight selling volume. So we wanted to come back up and make the market efficient. So if I pull this all the way over, you can see that we came into it. We didn't hit our stop loss, and we actually made a low, and then we pushed back up into that same level, swept this liquidity high. We can see that run just occurring by a few pips, swept that liquidity, still didn't hit our stop because this is market structure, right? This high produced this low, so we shouldn't come above this high. That's why stops are at the perfect placement. So we would expect a lower low from this level. And in the process of doing so, we generate an order block, okay? So we sweep liquidity, creates this buy to sell move, we reprice and continue. If you want to look at it from a market structure standpoint, higher high, higher low, higher high, higher low, higher high, higher low, failed to make the higher high here, and we made the lower low. So now this becomes our supply or order block here, and we can see that better on the 1 hour time frame chart. So now I'm going to just move this over. 1 hour time frame chart right there, that green candle, boom, that creates our order block. Now we want to come back up, mitigate that order block, and then continue to the downside to hit our overall target. And we can see here that was our second entry. We had our first entry right in here. Remember the distribution that occurred? We pushed up a little bit further, but it's okay. Creating this order block here, this supply level, we broke the bearish structure. Bullish structure was not maintained to the upside. So that's why we want to pull back and continue with the overall direction of the market based upon market structure as well. So market structure is definitely very important in conjunction with all the other smart money concepts. So we continue. It is, let me just see, it is currently July 28th. And what do? We create liquidity. Look at how this works, guys. I'm going to extend this all the way over. Look at how this works. We generate so much liquidity. Again, just like we had in here, lower low, the false lower high, lower low, overall pullback, take liquidity, come into the true order blocks, and then fall. Same thing here, lower low, lower high, lower low, lower high. These fake lower highs, lower low, we want to come all the way back up, sweep this liquidity in here, descending liquidity, and come up into our real order block and then fall. Because overall pullbacks, we want to be pulling back into premium price. This is premium above the 70, well, really above the 50%, but 61, 71, 78.6, back up into premium price. We don't want to be selling in here because that's not premium, that's discount. No one likes to sell things on discount, right? If you're selling a pair of shoes that are worth $200, you don't want to sell them for $100 when you can get $200 from them. You don't want to sell them at a discount. You want to sell them maybe at $250 and see if you get any offers, or $200, right? That's premium price. That's what you want to get out of those shoes. Same thing with the market. You want to be selling at the best possible price. These institutions want to get the best bang for their buck. They don't want to get in the market down here. They want to get in at the best possible price, and they do that by taking liquidity, maintaining their orders that are in here. They're not going to push higher than that because they've already generated orders in here that they mitigated, and they want to mitigate these orders. There's no point. There's no logical reason for them to push price any higher. Why would they push price higher than they're already starting to push price down from? Why would they go an unnecessary drawdown? They don't need to. They want to mitigate, break even on their shorts, or excuse me, on their buys to then get out and continue with their overall shorts, right? If their short started here or here, why would they go higher than that? They're just being drawdown. That would be dumb. Get out of your buys, continue with your shorts, make money. See, that's how we can utilize discount and premium as well. So continuing here, we do it again. We generate more liquidity. 1 touch, 2 touch, 3 touches. We had the reaction. Many people are selling off this triple top here or triple trend line touch. Generates liquidity. We push back up into our area of interest, mitigate. This is what we do. We go to a lower time frame. We come back up, tap into it, push down, come back up again. See, they probably couldn't get out of all their orders or add the rest of their sell orders in because their contracts were, the volume was just too large. So they have to come up multiple times to do so. But after they have done so, boom, right back to the downside. That's why it's such a strong move in one direction, right? So we continue, and now price is sitting right here, real time. So where's the new order block? The new one is where we swept liquidity in here, maybe to add on more positions, whatever. There's imbalance within here as well. So this would be your overall order block in here as well. So if we get pullbacks up into that level, we have broken the counter trend structure in here. We have actually created more liquidity by those equal lows relatively. We have a couple more relatively equal lows there. And we're looking to take that sell side liquidity, ultimately create a new low. Overall targets for this, now this is where I have the risk to reward tool correct. And we sold it right there. Let's call this, I think it was 15 pips. Yes, it was. And then we had 6, 5. There we go. 1 to 13.35. But at this current time, we are only in, let's see, at this current time, we're in 1 to 1.243. Let's call it 1 to 2.4. So 2.4%. And then we had this take profit hit at 3.5% or 3.6, 3.59, same thing. So 3.6 plus 2.4, that is 6%. All right, so that's 6% with these two trades, and on AUD NZD, that happened to be 13.5%. So that is a total of 19.5% currently with just those two pairs. That's technically 2 FTMO challenges if you want to equate it like that. All right, guys, so I hope you took some value from this. I hope you enjoyed this video. Hopefully this kind of introduced you a little bit more into the concepts of supply and demand order blocks and, market structure, as we talked about as we were going through. It's so important to understand market structure before you get into all the nitty-gritty concepts like imbalances or supply and demand or order blocks. But I hope you guys took some value from this. So have a great rest of your day and stay tuned for the next video. Thanks.